Correlation between interest rates and stocks. Interest rates and stock markets are the two main factors that play an important role in the economy as a whole. Interest rates change based on the central bank's policy decisions, which affect the liquidity of the economy and investor sentiment. On the other hand, the stock market fluctuates based on the performance of a company, its economic outlook, and investors' expectations. These two factors are closely correlated with each other, and changes in interest rates affect the stock market in a variety of ways. Interest rates refer to the price of money, the interest rate that the central bank sets to control the economy, which plays an important role in promoting or curbing economic growth in the short term. Interest rates can come in many forms, including central bank policy rates, interbank transaction rates, and long-term government bond rates. Interest rates determine the cost of a loan, which directly affects a company's capital cost and consumers' spending habits. In general, when interest rates rise, the stock market tends to fall, and when interest rates fall, the stock market tends to rise. This comes from a number of economic factors and investor behavioral psychology. When interest rates rise, the cost of loans for companies increases. This reduces the company's profit margin and negatively affects its stock price. Furthermore, rising interest rates increase yields on bonds, which allow investors to move funds to safer bonds. The result is an outflow of funds from the stock market, increasing the likelihood of the stock price falling. For example, the stock market was hit hard by rising interest rates in the United States in the 1970s. At the time, the U.S. Federal Reserve raised interest rates sharply to curb high inflation, which reduced corporate profit margins and led to a slump in the stock market. Conversely, falling interest rates reduce the cost of capital for companies. This increases the company's profit margin and promotes a rise in stock prices. Also, lower interest rates tend to lower yields on bonds, shifting funds to stocks where investors can expect higher returns. This inflow of funds could lead to a rise in the stock market. For example, after the 2008 global financial crisis, the U.S. Federal Reserve cut interest rates to near zero, which was instrumental in facilitating a strong recovery for the stock market. The low-interest environment has allowed companies to raise funds at lower costs, which has had a positive impact on the stock market. Changes in interest rates can increase volatility in the stock market. Investors may interpret the rate hike as a sign of a slowdown in the economy, which increases uncertainty in the stock market. On the other hand, if interest rate cuts are interpreted as a boost to economic growth, the stock market could rise. This volatility provides investors with both opportunity and risk. Higher interest rates often mean slower economic growth, which can increase volatility in the stock market. Investors rebalance their portfolios against higher interest rates, which could lead to drastic swings in stock prices. For example, between 2015 and 2018, when the U.S. Federal Reserve raised interest rates, there was a significant increase in volatility in the stock market. At the time, investors were anxious about the impact of higher interest rates on economic growth, which led to a repeat of the plunge and surge in stock prices. Lower interest rates can also increase volatility in the stock market. In particular, if the central bank unexpectedly cuts interest rates, investors can take this as a sign that economic conditions are worse than expected. This can increase uncertainty about the stock market and increase volatility. However, if interest rate cuts are aimed at stimulating the economy, the stock market is likely to rebound. Interest rate changes do not affect all industries equally. Some industries are sensitive to changes in interest rates, while others are relatively more insensitive. One of the industries most sensitive to changes in interest rates is the financial industry. Financial companies such as banks, insurance companies, and asset management companies have a significant profit structure as interest rates change. If interest rates rise, banks can raise lending rates, which can increase profitability. However, higher interest rates can also reduce loan demand and increase loan insolvency rates, which can also negatively impact the financial industry. The real estate industry is also one of the interest rate-sensitive industries. Higher interest rates can lead to higher interest rates on mortgages, which can reduce demand for home purchases. This could lead to a slump in the real estate market, which also negatively affects related stocks. On the other hand, falling interest rates can boost the real estate market by lowering the cost of buying homes. The consumer goods industry is relatively less sensitive to changes in interest rates. However, if interest rate hikes reduce consumer confidence, demand for consumer goods may decrease. Conversely, falling interest rates can increase consumer confidence, increasing demand for consumer goods. Therefore, changes in interest rates can indirectly affect the consumer goods industry. The relationship between interest rates and stock markets may be intricately intertwined in the short term, but in the long run, it is driven by fundamentals across the economy. In the long run, interest rates affect economic growth, inflation, and corporate profitability, which is one of the key factors determining the direction of the stock market. In the long run, interest rates have important implications for economic growth. Low interest rates drive economic growth, which has a positive impact on the stock market. Conversely, higher interest rates suppress economic growth, which can have a negative impact on the stock market. For example, since the 1980s, the United States' continued low interest rate policies have propelled economic growth, which has led to long-term gains in the stock market. Interest rates are also closely related to inflation. The central bank adjusts interest rates to control inflation, which affects the stock market. Raising interest rates when inflation is high could cause the stock market to fall in the short term. However, if inflation stabilizes in the long run, the stock market can bounce back. Conversely, if you cut interest rates when inflation is low, the stock market could rise. The correlation between interest rates and the stock market will remain an important economic issue in the future. The relationship between interest rates and stock markets may vary depending on changes in the global economic environment, the policy direction of the central bank, and the economic situation of each country. Understanding the correlation between interest rates and stocks is an important strategic tool for investors. Adjusting portfolios to change in interest rates and selecting stocks sensitive to change in interest rates by industry can be a successful investment strategy in the long run. Interest rates and the stock market are closely linked factors, and changes in interest rates affect the stock market in a variety of ways. Rising interest rates typically have a negative impact on the stock market, and falling interest rates have a positive impact. However, these correlations may vary among industries, with fundamental factors such as economic growth and inflation playing an important role in the long run. It is important for investors to understand these relationships and to make strategic investment decisions based on changes in interest rates. In the future, the relationship between interest rates and stock markets will fluctuate depending on economic conditions, and analyzing them closely is an essential element for successful investment. Please subscribe, notify, and like. It's a great help for me to produce a video. Thank you.